They're spooky and they're scary, reverse mortgages. Don't be spooked by a reverse mortgage because it could provide security during scary economic times and conditions. Some people are more afraid of reverse mortgages than scary spirits. But your home equity could be the real ghost, here today and gone tomorrow. For instance, during the Great Depression of 1929, home values dropped on average 35%. So the value of a $6,000 home would probably have dropped to $3,900, a 35% drop, as this chart shows, resulting in a home equity loss of $2,100. During the Great Recession of 2008, home prices fell 50%. So a $300,000 home would have dropped to about $150,000, resulting in, as this chart shows, an equity loss of $150,000. The Great Recession of 2008 resulted in a $17 trillion loss in wealth, widespread loss of home equity, and 8 million home mortgage foreclosures. The economic ripple effect caused retirement accounts to decline by 25%. You see, the housing crashes of 29 and 2008 teach us that home equity, which many seniors depend on for their retirement, can evaporate within months. What's scary is that a housing price run-up, as experienced the past few years after COVID, preceded these historical market drops. Now, of course, no one can predict markets, and it would be foolish for me to claim I have a crystal ball to predict market crashes. However, since we can't predict the future, it would also be foolish for someone not to protect themselves from the possibility of housing equity losses as in 1929 and 2008. See, that's where a reverse mortgage line of credit could help, because it would, under certain circumstances, provide that protection. If you want to know how, stay tuned for my next video, which provides an example of how reverse mortgage line of credit could provide a hedge against a housing market recession, and just one example of why reverse mortgage is not so spooky. I look forward to your call.